Just a few minutes left in the trading day, about 7 to be precise. It's time for the big picture. Let's welcome in the team from Charles Schwab. Cooper Howard is Director and Fixed Income Strategist at Schwab Center for Financial Research. Michelle Gibley is Director of International Research at Charles Schwab. Michelle and Cooper, great to see you both. Michelle, let's start with you because markets in mainland China open for the first time in a week tonight. After the Golden Holiday, there's a fiscal stimulus briefing just after the markets open. How much is riding on this announcement?
Yeah, I think it's going to be the first big test of this rally we've had. 2 weeks ago, we had a flurry of monetary stimulus announced. We've been waiting for the fiscal side. And so, just 30 minutes after the market opens in Chinese markets on the mainland for the first time in a week, we're going to get this briefing and we're going to look at the size, composition, and timing of stimulus. Now, the first 1.6 trillion yuan of spending only makes up for the existing budget shortfall because policy's actually been tightening this year. So markets probably want more than 2 trillion yuan in spending or some kind of signal of growing that stimulus in the future. And in terms of the composition, we're going to probably look more favorably on anything that boosts consumption. Again, expectations are high. We've had a 37% gain in the MSCI China index just since mid-September. That said, Chinese stocks are trading under 12 times forward earnings. So if policymakers can, keep boosting confidence, the stocks could have further to run, although, it could be a bumpy ride.
Yeah, I think that's the big question is the rally sustainable and how much more can it run higher? I know you've talked about it being tradable versus investable, but if you take a look at U.S. listed shares of Chinese companies, Alibaba, Baidu, Xpeng, Li, Tencent, all seeing notable strength today. So is that a good sign for the sustainability of this rally?
I think expectations are high. We just got a notice of this meeting, last night in terms of Asian markets. So we're hoping to see more. It seems weird just 30 minutes after the open. Hopefully they don't have bad news. Hopefully it's good news.
All right, Cooper, let's turn to you and look here in the U.S. We have inflation data. We have Fed speakers on deck. Let's talk about those Fed speakers because how much do you think they're going to have to be kind of level setting expectations about future rate cuts based on last week's jobs data?
Yeah, I do think that last week's job data really put the 50 basis points debate to bed. So our expectation and where the market is pricing in things right now, Caroline, is that there's going to be another 25 basis points worth of rate cuts this year, and then also additional rate cuts going into next year. But by my count, we have 20 different Fed speakers this week. So that's quite a lot. We also have the FOMC minutes. Now, granted, these were before last week's non-farm payroll. So I don't really think that that's going to try and kind of change the direction of Fed policy or kind of change things for the market, how they're interpreting Fed policy, because they are a little bit outdated at this point. What I do think that could cause a little bit of surprise, though, are those 20 different Fed speakers. So we'll see how much influence they pay towards last week's non-farm payroll report, which by all accounts was a blowout in pretty much any measure that you look at it at.
Cooper, do you think this is a market that would be okay with one more rate cut this year, one more 25 basis point rate cut?
I do think that it probably would be okay at this point. I think that it's priced in at this point. So I don't think that that would come as too big of a surprise. But keep in mind, expectations for rate cuts, they're largely data dependent. That's what the Fed has been telling us. So we do expect that as the data evolves, then that's going to influence what the market expects for rate cuts and kind of how we look at different things. If we harken back to the last time that we got a rate cut, remember back then that even on Tuesday, the day going into the Fed meeting, the day before the Fed announcement, the market was largely up in arms about, is it going to be 25 basis points or is it going to be 50 basis points? So there was still a little bit of that debate. I do think that if we look back at the non-farm payroll report, like I said, yes, it was gangbusters and it was good in a lot of measures, but it was only one report. So let's not make that the influencer. Let's see if it's a direction of a trend. And then I think that that's going to kind of influence things going forward. So you don't want to put too much weight into one report, although it was an important report.
Yeah, and some of us were surprised by that 50 basis point cut, although all the reasons that the Fed cut by 50 were the reasons I thought that they would cut by 25. Michelle, what about other central banks around the world? What are you keeping an eye on right now?
Yeah, other central banks remain on a rate cutting path. We had policymakers both from the European Central Bank and the Bank of England last week signaling the possibility of rate cuts at their next meetings. And that's really a dovish shift from what markets were expecting. Markets were expecting both banks to pause. In terms of the Eurozone economy, there's been weakness there, and people are a little bit concerned about that. Certainly, the composite PMI fell below 50 in September, but the bad news it isn't necessarily bad news for stocks, because in prior instances when the composite PMI fell below 50, most of the bad news was already priced in by stocks, and so stocks look ahead. They don't look at the past, and with the ECB cutting rates, this can set the foundation for a more positive outlook for future growth.
All right, Michelle Gibley, Director of International Research at Charles Schwab, and Cooper Howard, Director and Fixed Income Strategist, Schwab Center for Financial Research. Thank you both so much.